Joining me right now with more on the implications of this sell-off is the Wall Street Journal's editor-in-chief, Gerry Baker. And Gerry, it's always great to see you.
Thanks, Maria.
Thanks so much for joining us. The worries continue to pile up. What's your take on this market?
So I think the question is, and continues to be, is the market seeing something that the world economy itself is not seeing, right? So the numbers, the broad general economic numbers still tend to be okay. They're not great. We've not had a great year in the world economy for a long time. But, you know, the U.S. economy is still growing, had good job numbers in December. The early numbers for, you know, the start of this year, not spectacular, but okay. And the mood here at the World Economic Forum, Maria, I have to say, the mood at the World Economic Forum is kind of always wrong. So you want to be very careful about it because everybody senses the consensus here turns out to be wrong. But the mood here is that, look, the economy's okay. China's going to grow. We had the IMF with its World Economic Outlook yesterday. China's going to achieve 6% growth this year. The US is going to achieve 2.5%. The world economy is going to grow over 3%. So there's this sense that there's perhaps a disconnect between what the markets are seeing and what we're seeing in the data of the economy. And the question is are the markets reacting like this? Is this an overreaction? And I remember somebody once said that stock markets predicted 9 of the last 3 recessions. Or is there something really going on? Is the market actually anticipating what may happen in the rest of the economy? And I don't think we know. I think the official view is pretty sanguine. I was speaking this morning to Christine Lagarde of the IMF and to other senior economists and business leaders. Their view is that things are going to be okay. I'm not so sure. I think that there is a convergence of negative forces right now in the economy that really don't look good, and they're hitting an economy which is not, you know, although it's growing, is not growing that strongly. So I think this is a time to be cautious.
I think it's really an important point what you said, that markets typically do portend to something. Markets have predicted 3 of the last major recessions. So you wonder if the market's telling us something that the 16 is going to be a lot worse than people think.
Well, the market sometimes doesn't get it. You know, markets are much more volatile than the economy. Thank goodness. The economy grows, you know, 2 or 3% a year, and the markets can be up 10% one year and down 10% the next. So the markets don't always tell us exactly what's going to happen. Sometimes they overreact, or sometimes they're reacting to particular imbalances which need to be addressed, whether in equities to do with prices of equities, or whether in bonds to do with bond yields. But I do think what we're seeing now is something that's coming together: real doubts about China, real concerns about commodity prices and what that's going to do to emerging markets. And I think on top of all that, you know, a real nervousness about the fact that have we seen 6 or 7 years, the last 6 or 7 years, have they been built largely on this massive stimulus from central banks, the QE in the US and in the UK and in Japan and now in the Eurozone? Has that just all been, if you like, artificially stimulated? And without that, is the world economy really strong enough to stand on its own 2 feet? And I think there's a lot of concern that it isn't. And the Federal Reserve, of course, raised interest rates at the end of last year. And now, according to the expectations, the Fed said that they was going to raise a total of 4 times in 2016. A lot of people changing their estimates on that. We're going to speak with John Hilsenrath on his ideas about the Federal Reserve coming up. But if the Fed were to raise interest rates now, while people are questioning this recovery, and while the economy is just gaining traction, that would set us back. Well, you know, again, I don't know about it. I think the Fed, frankly, has got a long way behind the curve. The Fed was continuing to pump this money into the economy. Look, I think QE in its first phase probably was helpful. It probably stopped the economy from going into free fall back in 2008, 2009. I think that was helpful. I think repeated doses of this medicine have had, as often happens with medicine, have had limited and less effect. So yeah. I think the Fed actually needs to get out of people's way and to say, look, which they're trying to do finally, to say, look, we're going to kind of normalize monetary policy. The economy's, you know, soft, but not in recession, and we've still got an interest rate policy that is the right policy for an emergency, for a recession, for a deep recession. We've got to get out of that. We've got to get back to normal, and we've got to see whether the economy can handle it. And I think the Fed does need to get on with it and see what happens, how the rest of the world can actually recover.
What's your take on where we are in the price of oil? I mean, oil has dropped 50% from the highs. You know, and we've been talking about it on this program, the knock-on effects of oil, cheap oil. So people look at oil as a catalyst. Well, you know, people are spending less money at the gasoline pump. They're going to spend that in the economy. We haven't seen that materialize. It's more of an indicator of a gloomy situation in global demand, isn't it?
I think that's right. I think there's a bit of a mystery right now about oil because, you know, exactly as you say, in the past we've seen Oil is down 20% this year alone. In the first 3 weeks of this year, the oil price is down 20%, as you say, more than 50% in a year. You would normally, in those circumstances, for the United States, for Western Europe, heavy oil consumers, even though the US is a big oil producer now, still it's a net consumer of oil. You would think in those circumstances this will be good news, right? It's putting money, gasoline prices are very, very low, companies are facing much lower energy costs. You would think natural gas is down. You'd think that was putting money into people's pockets, they'd go out and spend it, and that would be good for the economy. But every time the oil price goes down, the market goes down, and everybody worries that things are getting worse. I think there are two reasons for that. I think there is concern about producers, particularly in the US, and I think to some extent about the producers in the Middle East too, and the problems they may be having. But I think you're also right. I think people think, look, there is massive overcapacity in the world economy. There's massive oversupply. Well, I've just hosted a very interesting lunch, Wall Street Journal lunch. We had a bunch of CEOs around the table. Got a really interesting contribution from a CEO of a shipping company who says the amount of shipping, essentially of vacant shipping out there at the moment, the amount of idle shipping in the world economy is as big as he's ever seen it.
Wow.
There are ships idle off the coast of South Africa, off the coast of Brazil, off the coast of Singapore.
Yeah.
There is, and that indicates to me that the whole industrial capacity of the world economy is way too large for the demand, and I think that's what's driving the oil price lower, and I think it's that's making people nervous about lower oil prices.
That's a very important indicator, shipping. That certainly tells you things are standing still in a number of places across the world.